first of all, we keep getting all these hedge fund returns, and they're really, really good. Can you walk us through more of what we learned today?
Yeah, I want to be very clear because by and large, it's not that the hedge fund industry at large has been this blowout year. There's a lot of funds that lost a lot of money. Think the Tiger Globals of the world, a lot of equity funds, a lot of people who wanted to go short got whipsawed a lot last year. But the macro fund story, why is it interesting? Because some of those guys are now coming out, they're ready to raise money again, they're ready to hire, they're ready to get into different areas of work here. But what happens mid-year if you get to this point where interest rates start to hit a level where they're more stable? Does that start to change the game? What happens if you start getting whipsawed on some of those currencies that you thought you had a lot of conviction on, but all of a sudden you see a surprise move by a central bank around the world, which has been happening at a frequency that is probably less beloved than most people would like, especially because a lot of those trades are levered. So I think there are a lot of questions you have to ask about how far this sustains and who does well. I think also when you look at some of these returns, you start to have to think about the long term of what these returns are. Let's take Chris Rokos, for example. Banner year, 51% return. That brings him back from a really ugly year before. So we're starting to get a better sense of performance over the long term and what these managers can do now in a down environment as their investors, pensions, sovereign wealth funds are looking to hedge.
Sonali, are these funds, though, doing what they say on the tin, i.e. hedging risk? You want these funds to perform at these kinds of moments. Are they at least proving their capability to do that?
Depends on who it is. I think a good example of this here is kind of the story about Citadel and Bridgewater. Citadel here, Wellington, their kind of flagship here, posted more than 38% gain. And so why is that important? Because they've made money on things like fixed income, macro, quant, credit, as well as equities. So they have been able to kind of support you through this market environment. Bridgewater, classical hedge fund, not just a big money maker here, but classically born here to hedge you against a market like this. They had a blowout year until they didn't. And all of a sudden, performance started to come in at pure alpha by the end of last year. And so I think that it's going to be a really interesting question as to why people are buying these for the prices they're buying into these hedge funds for, because of course, some have gotten back past their high water mark. They can charge again. As I said, they're raising money. If you're Brevin Howard, you're charging pass-through fees so that talent gets a part of that fee pool as well, and fees are somewhat higher. And are they worth the fees at the end over that longer-term annualized basis?
I have to wonder, too, are all of the macro funds, did they all bet the same way? Did they all just have the same inflation view, and then that's kind of what happened here?
There were definitely crowded trades last year, right? Think about the dollar, right? I think that's the most
simple. If you were short
simple.
gilts, for example.
Yeah, exactly. And so there were definitely crowded trades. And that brings me to another point I want to make here, that the quants and the trend followers have done extraordinarily well. And some of those firms have become much bigger kind of multi-strategy funds, like D.E. Shaw, which has done very, very well last year. So yeah, some of the crowding has helped when it comes to trend following. Cliff Asness had its best year ever at a dozen funds last year, at 12 funds. And part of that was because they were following things like value, which David Einhorn said was done, but also had a stellar year. But then you also had him perform well, I want to say record year at Cliff Asness's macro fund as well. He's not known to be a macro investor, but that was certainly a favorable trade last year in which a lot of people made money. And by the way, the more people in those trades help support those trades.
Right, fair enough.
Sonali, do we know how some of these big funds are set up going into this year?
I think the thing I like about this is not even just the performance itself, because obviously, yes, last year set a bar. Can this year be as good as last year? Especially because if you think that, for example, if you take a Mike Wilson view of things and you think things are getting worse and equities might be tougher, then are you going to pay people to short? Are you going to be paying people to be doing maybe something different than they did last year? Commodities had a blowout year. Are you going to pay people to do commodities again this year? And so the talent story that surrounds that, who will be paid to do their job, is interesting because you've seen some people start up divisions that maybe they were not used to having within their funds. Non-traditional commodities funds creating a commodities arm. Can they sustain that? Because at the end of the day, if they can't sustain that, then they will have been spending a lot of their investors' money that they maybe wish they had not spent at the end of this year. But we'll revisit at the end of 2023.